Welcome to Ripple Edge, where we cut through the noise and give you the real picture on XRP. Let's get into it. JPMorgan just told the market it isn't ready. Not crypto Twitter, not your favorite influencer, JPMorgan. And if you understand what that language actually means coming from an institution that size, you're already ahead of 90% of the people holding XRP right now. Hit subscribe real quick. This channel covers institutional setups before mainstream picks them up, and you do not want to miss what's building. Now let's cut straight to it. JPMorgan published analysis confirming that the Clarity Act is functionally almost done. Not almost introduced, not almost debated, almost done. The number of genuinely controversial issues still standing between this bill and passage has been cut from roughly 12 down to just 2 or 3. Think about what that compression means in legislative terms. That's not bureaucratic crawl, that's a bill in its final sprint. The stablecoin reward debate that stalled everything out for months is now progressing. The SEC versus CFTC jurisdiction question, the DeFi classification problem, the stablecoin framework, all of it is converging at the same time. But here's what nobody's saying out loud about that JPMorgan note. When an institution of that scale says the market isn't ready for what happens when this passes, that is not analyst color, that is not casual commentary. That is institutional warning language with a very specific audience in mind, and that audience is not you. It's their clients, the ones already moving capital. When JPMorgan says retail isn't ready, they're drawing a line between who's positioned and who isn't. The question is which side of that line you're standing on right now. So let's look at what the data actually shows, because the data is where this story gets sharp. XRP whale accumulation just hit a 10-month high. The source here is CryptoCoin's whale flow tracker, running on a 30-day moving average. That metric just climbed to levels we haven't seen since mid-last year. Now pause on that for a second. Whale accumulation at 10-month highs doesn't happen because traders are guessing. It happens because large capital has a thesis and is acting on it ahead of a catalyst. And when you line that up against what JPMorgan just confirmed about the Clarity Act timeline, the thesis isn't hard to read. Smart money is buying the window before regulatory clarity hits the headline cycle. On top of that, exchange outflows are accelerating. That means XRP is moving off exchanges and into cold storage or long-term custody. Less supply sitting on sell side, less pressure on the ask. That's not noise. That's a structural shift in how the asset is being held. Then you've got the ETF data. Spot XRP ETFs just recorded $17 million in net inflows in a single day, the highest single-day figure in nearly 2 months. Bitwise led that move. Franklin Templeton was right behind them. These are not retail buyers panic buying a green candle. These are institutional allocators with compliance departments and investment committees putting $17 million into XRP exposure in one session. That is not FOMO. That is a position being built. Now here's where it gets sharp, because most people watching data like this treat each piece as a separate headline. They're not separate. They're the same story told 3 different ways. JPMorgan confirms regulatory clarity is imminent. Whales accelerate accumulation to 10-month highs on the same timeline. ETFs log their biggest inflow in 2 months during the same window. That is not coincidence. That is coordination around a shared expectation. And that expectation is that the Clarity Act passes, regulatory uncertainty collapses, and institutional capital that has been sitting on the sidelines finally has a legal framework to operate inside. There's one more piece to this that almost no one is connecting. The US Treasury just executed $2 billion in debt buybacks, bringing the monthly total to $19 billion in Treasury repurchases. $19 billion. Now you might be sitting there thinking that's a bond market story, not a crypto story. Here's why that's wrong. When the Treasury is actively reducing outstanding debt at that scale, it's preparing the balance sheet for a policy shift. It's creating room. And when you sequence that against the Clarity Act timeline and the institutional flows moving into digital assets right now, the picture that emerges is a government and its financial infrastructure actively clearing space for a new framework, one where regulated digital assets like XRP have a defined, legal, institutional role in cross-border payments and financial infrastructure. Ripple isn't a side bet in that framework. Ripple is a direct answer to the problem that framework is trying to solve. Now let's talk about what the chart is actually showing, because the technicals here are not contradicting the fundamentals, they're confirming them. XRP has made a move from the 133 range up toward the 141 to 142 level. The weekly candle forming right now is the first constructive weekly candle we've seen in several weeks. The RSI on the weekly is beginning to curl upward. The 120 support level that has been tested multiple times has held each time it was touched. Volume has come in on this candle, and the candle body itself is healthy, meaning buyers are not just pushing price up intraday and giving it back. The body is closing with conviction. Here's the one thing that matters above everything else on this chart right now. The weekly candle has not closed yet. Everything hinges on Sunday's close. A weekly close at or above $1.40, with the RSI continuing to turn upward, is the first clean technical signal that the local bottom is confirmed. That opens a measured move toward $1.60 to $1.70 as the near-term target range. If price clears $1.70, the next meaningful resistance sits at 2.0 south. That's the major psychological level. It's the pre-SEC lawsuit all-time high zone, and it's the level this market has assigned significant structural weight. Above $2 mid-resistance comes in between 220 and 384, and historically that zone compresses fast once the $2 level breaks. The move from 220 to higher has happened quickly in prior cycles, and there's no reason to expect a different dynamic this time given the macro setup building underneath it. But here's the part where this channel earns its name, because the real edge isn't the bullish case. It's the honest framing of where we actually stand. The macro downtrend from the all-time high is still technically intact. This is a relief rally until proven otherwise. You do not have confirmation of a full trend reversal until XRP closes a weekly candle above 170. Until that happens, this is a recovery in progress, not a breakout confirmed. 3 of 4 reversal boxes are checked. RSI turning up, support held, volume came in, candle body is healthy. The 4th box is the weekly close. That's Sunday. That's your confirmation or your invalidation. The current zone around 140 to 142 is reasonable for accumulation with a tight invalidation level at 120. If 120 breaks on a weekly close, the setup changes. But right now, 120 has held every test. This is not the setup for aggressive leverage. This is the setup for measured, patient positioning by people who understand what they're buying and why. Here's what that means for long-term holders specifically. You got in early. You survived one bear market, maybe 2. You held through years of SEC litigation and FUD cycles that shook out weaker hands at lower prices. The worst thing you could do right now is let short-term volatility rattle you out of a position right as the institutional thesis you've been waiting for starts to materialize in real data. Whale accumulation at 10-month highs, ETF inflows at 2-month highs, a legislative framework in its final stretch, a Treasury clearing its balance sheet, and JPMorgan telling its clients the market isn't ready. The weekly close on Sunday is your line in the sand. Above 140 with RSI curling up, recovery mode is confirmed and the path to 160 to 170 opens. Below 120 on a weekly close, you reassess. It's that clean. No guessing. No narrative overrides the price action. But right now, price action and the macro narrative are telling the same story from different angles. When that many independent data points converge on the same conclusion at the same time, that's not analysis. That's the market revealing its hand before retail figures it out. That's the edge. Stay sharp. Subscribe so you catch the next one before everyone else does.